Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. Today I've also got two additional trade ideas for us to check out towards the end of the video, so definitely stay tuned for that. Let's kick off the S&P analysis as we always do with our sectors, who was leading, who was losing, and where was the weight, of course. The XLK led the pack today, up 0.59%, whereas the XLRE for real estate was down at the bottom of the barrel, down 1.66%. As we know, the XLK is also the top dog. It's the heaviest weighted sector. Nice to see it at the top of the list. We also have the XLF for the financials, second heaviest weighted sector, again at the top of the list here, up 0.26. And then we have the XLV for the healthcare sector, third heaviest weight, down 0.52%. Now, before I get ahead of myself, this is a little bit of a deceiving story here. We know that a majority of the progress made in the XLK, the reason it's at the top of the list here is because of the Microsoft gap up on earnings. I think what's a little bit more telling on today's true action is if we measure from today's open instead of this column, which is yesterday's close. If we do that, obviously everything on the list is red, so we're sorting from the least red to the most red. This tells a completely different story, right? The XLP for consumer staples, a defensive name at the top of the list. XLV, although it's a heavier weighted sector, it's still defensive at the top of the list. XLF is kind of only up here because of the FOMC. We'll talk about that when we get to it. XLU, defensive. XLE, defensive as well. And notice where your XLK actually falls. It's in the lower 50% of our sector ranking here. So wanted to point that out, a little bit more nuanced, but certainly worth paying attention to. Let's check in on some of these charts and see how they're shaping up. We know that the trends have primarily reversed over the past couple of weeks. We've been discussing that. So what we want to point out here is where things are either going to accelerate to the downside or where things will soften and maybe your SPY starts to catch a little bit of a break. So the main risk in the XLK right now is the fact that this could potentially turn into a bear flag, consolidation, breakdowns, start to get a little bit ugly. Obviously, we're respecting this big area of support here around 148. That's a good thing for now. But if we start taking this area out, the last line in the sand is at 143.50 coming from these prior highs. And then underneath that, the next major structure is much further below around 131.76. Now, granted, maybe there's a bump in the road here, but one step at a time, right? What I'm getting at is when there's a lack of market structure, when a market moves almost straight up or straight down, you can generally move through that area much quicker than moving through an area of high structure. Like this is kind of why we stopped here, because there's market structure there. It's not like we were on a straight shot higher. And this is, I can prove this to you literally on this chart, right? If we look at this area of the chart, there's very little market structure there, and we slice through it like a hot knife through butter. So it's going to work in both directions. We talked about the downside risk. Things are going to perk up in the XLK if we can recapture 156. And again, it's going to work in both ways. So this lack of market structure here and here should mean that a break and recapture of 156 gets us to 164, maybe sooner than we would think. Now, please don't get me wrong. The pattern is unfolding as bearish. We're also underneath the daily 200 SMA. This is a failed break on today's session of 156. It's very likely that we form some sort of lower high down here from here. Again, more bearish than bullish, but those are the general areas where the trend will either accelerate to the downside or it maybe softens what happens in the S&P if we recapture 156. Let's move along and talk about the XLF for financials here. Notice the stark contrast, right? We were talking all about market structure on your XLK. Look at the XLF, right? Look at all of this congestion from in the past, these areas of just, lots of back and forth, two-sided trade. That's going to mean it should be, and again, there's no guarantees in the marketplace, but it should be more difficult for the XLF to completely fall out of bed and make it to this area here around 33 than something like your XLK. That's all I'm getting at. This would strike me as being a little bit more healthy and really hardy, more resilient rather, is probably the proper word for it. Now, don't get me wrong. Yes, this pattern here certainly is bearish, falling out of these highs back down underneath this area of support with a lack of a dead cat bounce off of the top end there at 39.25. So yeah, it's definitely thinking, more bearishly than bullishly, if that's a phrase to be used. So again, chop probably in here. We've seen that. We've experienced it in the past as well. That would definitely lead to an area of lower value, lower price acceptance, which again is bearish. And then maybe in the future, it's a breakdown of 37.25, which should take us to 36. Now that's 36, excuse me. We know that that's such an important area because of all of these interactions here, as well as the one perfect touch on that panic gap down from, what was that, September, right? So that's what we've got to the downside in the XLF. Obviously, that will continue to hurt the S&P 500. The XLK is really the dominant driver. So any sort of moves higher here that are not aligning with what's going on in the XLK will probably also soften what happens in the S&P 500. So if this recaptures 39.25, but the XLK cannot get above 156, you probably have more of a sideways S&P 500, right? The other thing to point out here is the fact that we do technically have cleaner higher lows as well as higher highs on a bar by bar perspective in the XLF. Let's continue along and talk about the TNX now while we're talking about financial things for the 10-year Treasury. And the main thing I want to talk about here is really what came of the FOMC announcement from Fed Chair Powell. So during the FOMC, he basically reiterated that things are kind of on track and on par for the taper to wrap up and rates to be scheduled, or excuse me, not scheduled, but to be hiked as scheduled. There we go. So he didn't really throw any curveballs at the marketplace or say anything that the marketplace didn't like until he got to the part where he said inflation actually hasn't gotten better than what we had last month. So the market didn't like that, and that's really why we started panic selling closer to 2:30 when his press conference was, as opposed to when the meeting minutes came out at 2 o'clock. So that's the main takeaway from the FOMC, and in terms of how that relates to the TNX, if the TNX continues higher, it's going to continue to break your S&P 500. We know that there's a disjointing point between the TNX and the XLF for financials. Sure, they're going to be making more money on their loans as rates increase, but you get to a point where people say, you know what, I'm just not really incentivized to be borrowing at these really high percentage rates, right? It's just not as attractive as an option anymore, so they don't borrow. And obviously, higher rates won't matter if people aren't borrowing. So that's the upside. That's not good for your S&P 500 if we go higher. If it goes sideways, it's a non-event for the S&P 500, and if it rolls over, it's probably going to benefit your XLK, the tech sector, which should perk up the S&P 500. Now, I don't think that this is a likely scenario here that rates move lower, especially given the fact that we're in an environment where the Fed is, supporting multiple rate hikes in the year of 2022. It's all a matter of, okay, do we get our first rate hike at 0.25, which is what's been discussed so far, or will it be a double rate hike, and do we get 0.5 out of the gates? That would certainly not be a good thing for the S&P 500. So that's what I've got for you in the TNX and the relationship between it and the S&P 500. Let's round out our sectors now with the XLV for healthcare. This one's not really, again, I've pointed this out in the past. This is sort of taking a back seat to your XLK and your XLF. That's the main stage there, and the XLV is kind of just hanging out in the background. I would point out a majority of the same things I've talked about in the other sectors. This risk is turning into a bear flag here. We have 3 days of sideways price acceptance lower, more bearish than bullish. If this area breaks, we do have a dominant area of support from in the past here around 120, 122. So, one step at a time. I would probably, if you're really intent on trading the healthcare sector, which again, I don't think it's the main stage right now, but hey, to each their own, it's probably a break of the 2-day lows just to get to Monday's low. And then I would reassess the chart from there, noting that we're at a critical area of support, 124.85, call it 125 even, right? If it's going to break out, it's up and over the 3-day highs. They're stacked nicely, forming a bit of a pressure cooker top. It's also this prior area of structure. So if that goes, I would imagine this may happen sooner than we think based on support, then turning perfectly into resistance on the back test at 133.30. So that's the XLV. Again, the pattern would suggest a little bit more bearish than bullish, but we have levels to be watching out for. Obviously, we also know, if I grab the other tool, that support trend line has clearly been breached, right? And we're firmly underneath it. So that's what I've got for our sectors. Let's continue on and talk about the VIX. So VIX, there we go. And what I want to illustrate here is a longer term thought from the 2-year weekly, okay? So you can clearly see this is an area where the VIX has been knocked down in the past. That's what we came into during the earlier stages of the Monday sell-off, close to 40 handle. And the question is, on the pullback, do we start finding a new floor at 2050 like we've done in the past here and here? Or will we move back down underneath? If we find a floor above 2050 now and start doing something like this, and then boom, maybe there's another spike in the future, that's going to lead to a very difficult, or I guess quite frankly, a volatile market condition for the year of 2022. So please just keep that longer term thought in the back of your mind. We are at that level where historically volatility has started fading off. So maybe things start to contract a little bit here. Let's go down to the daily. You can kind of see that, sure, we did get that massive upper wick on Monday, but we're still kind of hanging out out up here, it's not like we're firmly immediately back down at that 2050 for potentially a move back down underneath. So volatility is still high. All it means is adjust your stops and targets. So if that's your traditional entry, that's your traditional target, that's your traditional stop, your target should now be a little bit bigger and your stop should also be a little bit larger. Don't forget, try to keep the ratios all in line. Like that ratio here shouldn't change too much. This is probably not an accurate drawing, but you get the gist. So that's all we've got inside of volatility. We know it's high. We know it's a crazy marketplace out there, but the longer term thought is really what I think is most important to be thinking about in 2050, how that responds as we sort of come back down. Over on to the S&P 500 chart now to talk about tradable levels into the upcoming week. I know we've discussed a lot in terms of sectors. It does look a little bit more bearish than bullish out there right now, and I would echo that sentiment for obviously the broader marketplace here, the S&P 500 in mass. You can see we're underneath the 200 SMA. We're fading off of this area, which we've identified from in the past as being important at 443.50. And we have, price acceptance lower. That's going to be sort of abundantly clear on the market profile chart when we can look at value and where it's stacking up. We'll get to that in a second. In terms of levels to be watching out for, just like I mentioned in the XLV, I believe it was for healthcare, under the 2-day lows around 428.50, probably opens the door for Monday's low, and then I would reassess the chart. The next level we have underneath is coming from prior market structure. You can see that here, as well as in there around 411.63. I'm not saying we get there this week, but that's just the next structural element to be paying attention to. Because volatility is so high, because the ranges are so wide here, I think it would also be a good thing to take a quick look at the 30-minute time frame. And what you'll notice, I want to walk through some of the structure that exists here. Prior inverted head and shoulders, right? The shoulder line acted as support and the neckline acted as resistance into Tuesday. Notice how the pullback respected it on Tuesday, and it starts to look like we could form higher lows here. There's potential for that as long as we remain above 428.50. So that's your line in the sand if the chart is going to reverse here in the S&P 500 into the remainder of the week. Above 428.50, fine. Continue to look for this short-term intraday 30-minute uptrend to continue to pan out. We know 443, as we've just discussed on the daily, is that next critical area. And I mean, it's just perfectly illustrated as resistance for a double top here on today's session. If it breaks 450 is the next milestone to reach from the daily time frame. Because as we know, that's really where the breakdown stemmed from, right? We have all of that in here. Breakdown really got nasty as that level started to break. So those are the main areas I'll be watching out for into the remainder of the week for the S&P 500. Let's take a quick look at our internals here. If you're not familiar with this screen, please get familiar. Top right-hand corner, we'll describe what this all is, how you can set it up, and how it'll help you make better intraday trading decisions. Now, what I want to point out here is how internals can give you a sense of volatility, because as of right now, they're certainly not confirming any sort of direction. If you look at the volume read, notice how it was almost, horrendous on Monday, coming into minus 500 million. Traditionally, we're only looking for the 300 reads, right? So we're net 200 below what we would consider significant, and then all of that reverses into the close, right? And that sort of leads to the idea that maybe that was a bit of a capitulation bottom, the massive volume that was flowing through the market and then flowing back into the market. Maybe one step at a time. I would prefer to look at the levels as opposed to speculate based on volume, but I want to point out the volatility, right? And then the same thing on today's session as we're moving higher throughout the course of the day, almost making it to that 300 million. And as soon as Jerome Powell opens his mouth, boom, we're back down at negative 300 million. So volatility and the flows in and out of the marketplace right now are absolutely insane. There's also a high degree of correlation out there, which, as we know, generally speaking, does not sustain any typical trend. As you know, you can only sell everything so much before you have to rotate into something else. And if you've sold everything, there's nothing left to sell, then you have to buy, right? If you're someone who needs to allocate capital and keep things moving around, like most 401ks, big hedge funds, whatever, they need to be making moves for their clients, right? So as this big correlation happens, it's just indicating to me that, hey, this probably isn't sustainable, at least to this degree in the short term. And the very next, or at least on today's session, right? It's the exact opposite. It's huge degrees of correlation to the upside at first, and then falling off of a cliff as Jerome Powell gets on the mic once again. So huge volatility here. We'll kind of breeze over the tick a little bit, really just not making any significant moves here. Sure, Tuesday's build was, net 5,000, which is important there. But ultimately speaking, the very next day, flat, right? All of these flat reads here are just sort of indicating that nothing's truly trending in one direction or another. Now, don't get me wrong. Yes, we are looking at a more bearish marketplace than bullish, but this is just what I'm seeing in the internals. Lots of volatility. They're almost, I don't want to say not useful right now, because they're always useful, especially intraday, but Definitely not something I would be basing my entire analysis off of if this is something you use on a day-to-day basis. That's kind of what I'm getting at. Also, I suppose the last thing, I promise this will be the last on the internal screen. Notice all the emotional ticks on the Jerome Powell thing. I mean, that's traditionally what happens during, high periods of volatility when there's news announcements being released, but that's not sustainable. And you can already see in the after hours in the ES that we are perking up a little bit here, and we're starting to retrace some of the move. Now, I don't know if it retraces all of it or not all of it. We'll talk about that on the market profile here, but this not sustainable in our tick. Let's come on over to the market profile now. Again, I've got a video for you just so you can understand the terminology and what you're looking at here. If you've never seen it before, definitely check that out, top right-hand corner. The main thing I want to point out here is the fact that the point of control has actually migrated higher during this period of balance. And this kind of maybe it supports the theory of capitulation a little bit higher or a little bit more than I think, but here we go. So point of control Monday, point of control Tuesday, higher. Point of control today, definitely higher as well. And we almost got a spike based on Jerome Powell's, late day sort of sell-off there. But there's enough time spent where we're not going to classify it as, traditionally a spike there. Instead, I would just start thinking about this on the market profile as a 3-day balance with the point of control migrating higher. So maybe there's an opportunity for us to break out of the top end. I don't entirely know. The orange line represents where we're currently trading at. And as we know, whenever we're referring to areas of balance in the marketplace, generally speaking, your edge is never at the midpoint. The edge is literally at the edges, looking for a breakout or mean reversion. Same thing is true at the bottom, mean reversion or some sort of breakdown. So that's what I would watch out for here. From the market profile sense, there's really nothing, structurally that's, not sound here. Maybe there was a poor high here, but that's been repaired on today's session. Good excess on today's lows, good excess on today's highs. I guess the main thing to point out was just simply be the fact that, yes, in fact, the point of controls are moving higher here. Let's move back on over to the platform and round out our broader marketplace here. So going over to the QQQs, and what we'll notice here, very similar to everything we discussed in the XLK, obviously, bearish acceptance, 3 days lower. Let's quickly take a look at the 30-minute time frame, just to illustrate those equivalent S&P levels, right? So there's your inverted head and shoulders. Shoulder line is offering support. Maybe it's the higher low into the remainder of the week and the start of this trend reversal here, but one step at a time. We are getting some hammers, right? So the buyers are responding to this visual area of support. We'll see if it does perk up. The breakout point, very easily identifiable, just like in the S&Ps, is up and over 353.89. If that happens, maybe the move is to here, right? That sort of sneaky level from the intraday on last Friday at 361.64. Anything after that 369 is the daily level that does start to shift the tone in the marketplace, right? If I do something like this, you'll notice that that's here, 369, where the flush really began from after this, first lower low. So that's really the gatekeeper for repairing more structure in the QQQ. To the downside, because again, don't forget that we are in this bearish slump right now, underneath the 2-day lows, which is the shoulder mark from the Monday inverted head and shoulders, breakdown there at 341.82 takes us to Monday's low, and then we'll reevaluate. That's 334 quarter. Anything underneath based on structure is coming from this prior gap that exists. Again, you're not trading for that gap range. This is simply acting as a target between 323.93, call it 324 even, down to 322.85. Okay, so that's the first one underneath Monday's low, and then the lows from in here, roughly 315. Let's move along and talk about the IWM, then we'll get into those two trade ideas. Let me just quickly grab, let's go to the weekly actually. I want to illustrate the same concept I was talking about on the XLK chart. Lack of structure here should be moved through fairly easily. Now, I'm not saying that the IWM immediately rotates to 164.20, but again, there's nothing overly supportive about that market structure. If we were to look at it on a daily time frame chart, and let me grab some more time so we can actually see it. There's some areas where maybe there's a bump in the road, don't get me wrong, and that's kind of where we're supporting now, around 190, 170. That's coming from here. Next breakout points at 184.50. You get the gist, but overwhelmingly speaking, the next dominant area to really be focusing on is that 164 quarter way down there. For now, bear flag, just like everything else we've discussed so far today. Here it is, doing something like this, multiple days of sideways acceptance lower instead of, that firmer breakdown like we saw on Monday in some of our other sectors there or market Market indexes. Sorry, I had a lack of word for today. Anyways, so here you go. 3 days of balance. It's either up and over the highs or down and out underneath the lows. 191.70 takes us down to 184.50, and then that 164, as we mentioned, up and over the highs. Let's go ahead and map that in together. Up and over 202.80, all about the backtest of 208. We know that that's the breakdown point of the weekly range that we've been stuck in for what felt like years in the past there. And I would really expect some sort of negative reaction on the backtest there. So definitely be on the lookout for inverted hammers, indecision dojis, anything that would signal that the buyers aren't fully in control and it's nothing more than a dead cat bounce. Based on today's activity and the weak candle close here, yeah, definitely looking for this bear flag to start panning out lower as opposed to higher. So that's the broad marketplace in a nutshell today. I know we talked a lot about it, but let's get into these two individual trade ideas. First one is going to be on AMD for... Oops, AMD. Can't type either, apparently. There we go. And this is just a bearish consolidation, right? We have 3 days back-to-back sitting right on top of the daily 200 SMA. First touch is usually the most important touch, and the fact that it didn't really resolve higher would indicate to me buyers aren't really willing to step up here. The next major support is coming from this daily structure there around 100 even, psychological number, right? So a breakdown of the 3-day range is starting to become a little bit attractive in AMD if the broader marketplace continues to slump here. So that's my downside play in AMD. Breakdown underneath, basically 108.50s, 108 even if you would prefer to go underneath Monday's low. It is, what do we have there? 107.50, okay? So ranges are high enough, volatility is high enough right now where that could technically be in play into the remainder of the week. If it wants to take out the highs, that's fine. I would just let it do its thing. I wouldn't be overly bullish here, noting the structure and the broader marketplace context. Then the last one is going to be on SBUX for SBUX. And this is another bear flag. I mean, it's picture perfect, right? If you do something like this, kind of more like the IWM, to be honest with you, forming some structure that looks like that. The flush is underneath the lows here, close to 95. It is kind of sitting right through this prior daily structural area. And if that breaks, notice that there's some room to fall into that cluster of lows there around 93. So a $2 day trade, definitely a possibility into the remainder of the week. The complicating factor here will be earnings. They're not until next week, but if people start to position early, maybe that's a little bit of an issue there. If it really gets going to the downside, there's a gap to fill all the way down towards 91.31. Again, just like AMD, even if it wants to take out the highs here around 98.5, I wouldn't really be looking to play it that way simply because of the nature of this bearish consolidation, the bear pennant that's in play, and that's really all I've got for you inside of SBUX. So that's going to wrap up the video. If you enjoyed it today or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our secondary channel is linked down below in the description where we do 10 to 12 video ideas every single day, not every single week. That's every day. And all of that being said, I wish you all a green trading week.